Welcome back. You're still tuned into Trading Hour. Let's get a conversation on a particular sector, that's the specialty chemical space. In a recent report, Kotak Institutional Equities says they anticipate mixed results amid continued industry-wide challenges as the overall supply-demand scenario in the world chemical industry remains unfavorable. To discuss more on this, Abhijit Akella, who is an analyst at Kotak Institutional Equities, is joining us now. Abhijit, good morning. Thank you for joining in. Well, the conversations that we've had with corporates, they were indicating that maybe demand is coming back now. Your note says it's going to be a mixed set this time. Can you explain what are the reasons? Is it going to be a volume-led recovery, if at all? What's happening with pricing and demand now?
Sure. Good morning. I think while there is some improvement in results across a set of companies in the past couple of quarters, that seems to be stemming from the fact that there's a fairly easy base effect from last year. In addition to that, there's probably been some benefit from tariff-related front-loading of orders coming in from the Western geographies. And in certain specific product categories, there have been rising prices. For example, if you look at the HFC refrigerant space, which has boosted business for the likes of SRF and Navin Fluorine. And then in addition to that, certain companies have specific growth projects that are in ramp-up mode. So it's really a combination of these things that are leading to the pickup in revenues and earnings that we are seeing on a year-on-year basis. Actually, when you zoom out and look at the overall industry context at this point, and you look at the commentary coming from Western companies, such as the likes of, say, Dow Chemical or LyondellBasell, companies are generally cautious about the demand environment. There is still a considerable amount of oversupply sitting in China. And prices, barring a few pockets where they've gone up, have not really been, firming up of a low base. Plus when you factor in, the concerns going forward, such as, for example, the tariff-related uncertainties, which are really expected to play out only in the second half of this year. It's not a very, I would say, very encouraging macro environment just yet at this point anyway. So, that's broadly how things stand.
Okay, all right. So that's different from actually what you're hearing from some of the corporates as well. They didn't exactly say it's going to be a major recovery, but they did indicate there could be some recovery, so to say. On this tariff-related issue specifically, Abhijit, we don't have the contours out yet. But Aarti Industries did tell us that maybe the US tariff negotiations, what's happening with China, what's happening with the other Asian countries, that could be positive for India. Is that an indication that you're getting?
Very hard to hazard a guess about what exactly happens in the US in terms of tariffs, because that is a moving picture pretty much on a daily basis. But I think the broader point I just wanted to highlight is that there definitely has been some element of front loading of ordering coming from US customers, or maybe even global customers sitting in Europe who are in turn supplying to the US, because they've all been trying to beat the tariff deadline. And therefore, there is a good amount of inventory creation that has already happened in the last few months. We've seen companies like Kotak Chemical, for example, which is a major customer for PI Industries, highlighting such a development. So the concern going forward is that as this inventory overhang maybe starts to exert an impact in the second half of fiscal 26, could there be a slowdown in ordering coming from agrochemical customers or customers in other sectors?
Abhijit, good morning. Thank you for joining in. You mentioned in your note that there is a mixed trend that you're projecting, right? Stocks like Navin Fluorine and SRF could benefit. That PI Industries has a higher base, but Aarti and Deepak Nitrite continue to remain under pressure. What could work for companies like SRF and Navin Fluorine? Navin Fluorine has done fairly well in the recent past. It has also just completed a fundraise through the QIP. What are the likely triggers that can result in these companies outperforming over, say, the next 6 to 12 months?
So from a business standpoint, both companies are benefiting from the increase in HFC refrigerant prices, particularly R32. In addition to that, of course, SRF has been, guiding to 20% growth in its specialty chemicals business on the back of a recovery in agrochemical demand. Things have picked up on that front in the last couple of quarters, but as I mentioned, the risk or the concern to watch for is how much of that is front-loading led because of the tariffs, and therefore will there be a slowdown in coming quarters? So that's something to watch for. From Navin Fluorine's perspective, obviously, now having completed the fundraise, one would expect them to announce growth projects in the next few months or so. And then that is where the street's attention will shift. Navin already has a pretty strong pipeline of projects to execute over the next couple of years, which, by the way, is already factored into everyone's numbers. So I think the expectations for both companies already build in a significant amount of growth over the next couple of years. But in our opinion, the valuations already factor in most of that expected ramp.
You've spoken about UPL, saying it's going to be the weakest of the lot owing to challenges in Latin America and currency headwinds. Explain to us what we should expect from UPL. And the stock, I see, at least in the last 1 year, has done very well. It's okay. It's not bad. 16% up. Year to date, it's been a 30% up move. Now, given that it's going into its earnings with some gains, how would the stock fare over the near term?
Yeah, so when I mentioned weakest, I was actually referring to it in the context of the agrochemical peer group, not the broader chemical segment.
Okay.
The point here is that because they cater primarily to the international markets, and in particular, Latin America is their largest geography, which accounts for about 40% of the company's revenues. And Brazil in particular, which is the largest country in that region, is going through some very difficult times in the agrochemical industry. There has been more than a dozen distributor bankruptcies in Brazil in agrochemicals over the past year or so. So in that context, it's a difficult environment to show volume growth in. There's also a lot of Chinese competition that's been, flooding the market, plus therefore pricing pressure as well. So from all of those standpoints, it's going to be, one should expect maybe a subdued revenue growth for UPL this quarter on a year-on-year basis. Of course, it's seasonally not a large quarter. UPL's year tends to be very heavily back-ended, but we are already past that seasonal bump. And so, a soft quarter on a year-on-year basis in terms of growth. We should expect some improvement in margins, but then they will probably be some impacts from foreign currency related impacts because of all the currency volatility across the globe. Possibly one will also have to wait and watch if there are any settlements with any distributors regarding collections and whether that has an impact on the P&L.
Got it. So Abhijit, now that we're talking about cautious demand or maybe uncertain demand going forward, what are some of the spaces, barring agrochemicals, where chemical companies are investing or looking at investing, where they can get better returns or at least better orders going forward?
Yeah, so from our perspective, there are three stocks that we've been positive on for some time now. These are specifically Acuta's Chemicals, previously known as Ami Organics, which is primarily in the pharma CDMO space, but is also making a big thrust into the semiconductor chemical space through a recent joint venture they've announced in Korea. So we kind of like that story. We think there is good growth visibility there for the CDMO business, as well as beyond that. SH Kelkar is the other one. We think that's an interesting idea, undervalued in the flavors and fragrances industry, where growth prospects are steady, and there's a lot of operating expenses already built into the company's P&L, and so there's scope for operating leverage to play out over the next 2 to 3 years. The third one that we believe is still at reasonable valuations is Godrej Agrovet. So it's a very diversified story there, but we think that there are turnaround initiatives underway, across some of the more subdued performers, and there could possibly be an option of a demerger at some point in time as well.
Abhijit, thank you for sparing time and joining us to take us through this entire chemical segment, as Abhijit Akella there of Kotak, to talk about what to expect from the chemical companies this time around. By the way, we started